Why do multinational companies like Amazon, Apple and Netflix report billions in revenue in small countries like Luxembourg? Maybe you remember the times when you, as a European customer of a digital service like Skype, received an invoice from an entity in Luxembourg instead of from a contracting partner in your home country. Firms' tax planning strategies was the reason. For years, digital companies could minimize their tax bills by routing sales through countries with the lowest value-added tax, the tax you pay on top of the sales price of a good or service here in Europe. This, of course, created an unfair advantage to multinational tech companies. To address this issue, in 2015, the European Union changed the rules to charge the tax where customers actually live, a destination-based system. But did it work? And what were the unintended consequences? In my research with Lisa de Simone, we examine a lot of data to track what happens next. Here's what we found. Yes, multinational firms stopped shifting digital service sales to low value-added tax countries. But they also cut jobs in those places and reallocated employees and taxable profits to now save more corporate income taxes instead of value-added taxes. Ireland is the country that benefited the most from this strategic change. Because of the value-added tax system change, after 2015, Ireland became an even more tax-attractive location for companies like Apple compared to other European countries. So, what does this mean for tax policy and society? The tax reform partially worked, but when governments close one tax loophole, firms often find another. We believe this is why global tax policy should take a holistic view and be coordinated among governments worldwide. As the hot debates continue, including digital tax rules and global corporate minimum tax rates, understanding firms' responses and the impacts on consumer markets is more important than ever. Because in the global economy, how we tax matters.